Everybody, welcome to the Tuesday edition of the CLBA Webinar Series. Great to have everybody here this afternoon. We have a great afternoon lined up for everyone, but before we get there, the webinar series is brought to you by RCN Capital, the leading nationwide wholesale lender of real estate investment. So with that said, we have a couple of other good things going on for you. I want to let you know that we're almost at June, mid-June. We're going to have another one of our workshops coming up. I'll have more information soon with more details behind that, but be on the lookout for more information with that. Registration is open. As I mentioned before, make sure you get registered. The early bird special is still on, so take advantage of saving yourself a couple $100 on your ticket for the conference, and make sure you get your room reservations also. This is being recorded. If you want a copy of this, let me know. I'll make sure you get a copy of this so you guys can have it for your records. With that said, we have Access Private Capital, Mike Eady this afternoon presenting the SBA 504 program from Access. This is a great program. I've known Mike for a while, and I love listening to what this program is, and he has a great team over at Access. So Mike, I'm going to open this up to you, sir, and let you get to it. If you need anything, my phone's going to be on mute. Just let me know, and I'll jump right back in.
All right, I appreciate it, Scott. Thanks so much. Appreciate the opportunity to be here on the call today. I think this is maybe the fourth time I've done a webinar with CLBA, so I always appreciate the opportunity to jump on and share what's going on. I'm going to just run through a couple of things today. I'm going to give you kind of a little bit more background just about Access Private Capital. We kind of sit in a unique place in the SBA world. I'm going to kind of overview. I know a lot of you are probably very familiar with SBA, probably more so 7A. So I'll just to make sure we're all on the same page, I'm just going to run through the 504 program. And then I have a little interesting, I think a good selling idea for you guys as brokers. I want to kind of run by you, kind of take you through an example. As I go through though, I wanted to mention, if you have a question or want to make a comment, please, I don't know how exactly you do that, raise your hand or whatever you have to do, chat, type in the chat, and I'm happy to stop as we go along and answer questions, and also save a little bit of time on the back end for any questions or follow up. So yeah, so with that being said, let me just jump in and first of all, let me just give you a little background about Access Private Capital. We are a non-bank SBA 504 lender. We've been around, we started funding SBA 504 loans back in 2019. And I'll talk a little bit about what makes us unique as a non-bank lender. But we fund loans nationwide. Happy to go anywhere in the country in terms of funding. And then we've built our platform really around brokers in a lot of ways. Understanding that model, understanding kind of what you guys are looking for, and trying to be very broker friendly in how we structure our intake, our response times, just how we work with you guys. One of the things that is a little bit unique about us is you can do construction with 504, but the 504 or with any SBA loans, the actual SBA funding doesn't come until the construction is complete. So you get an approval beforehand, and then you go through the construction process, and once it's complete, the SBA comes in and funds. There's not a lot. Lenders are generally pretty shy about construction, even in SBA, but that's something we do a lot of, ground up, renovation, etc. And we've been doing this for a while. I think this is an old slide, so we're well over $100 million in 504 fundings since we started. So built a team with some experience on how to do this, how to structure deals, how to get them across the finish line in the SBA world. Just as a quick review.
Hey Mike.
Yeah.
I do have one question for you right out of the gate, if you're okay with that. Darrell, are you out there, sir?
Yes, I'm sorry.
There you go. Go right ahead, Darrell.
Put it in early. Sorry for the interruption. I was just asking how does the approval process work, and is it one loan or two? But it looks like you're going into that right now.
Yeah, I'll get into that, and I can kind of, I'm going to try to answer that question. I know a lot of you are familiar with SBA lending, probably more so the 7A tends to be a little bit more heavier focus for brokers. The 504 loan is really the one that's appropriate if you have commercial real estate. It's by far the better loan product from an SBA perspective. If you're thinking about 504 or 7A, if it's commercial real estate, it's generally better. 504 is going to be much better for the borrower, which I'll explain here in a second. But the structure is different. And the way that it works is you effectively end up with two loans. The borrower ends up with two loans. There's a first lien loan that usually funds up if the project's $1 million. The first lien is usually $500,000 of that, or 50%. There's then a second lien. That's the part that's funded by the SBA. And that is the next 40%. So in a $1 million scenario, you'd have a first lien loan for $500,000. You'd have a second lien loan for $400,000. And then the equity requirement for the borrower is 10%. And so for a commercial real estate loan, that's a really attractive structure to only have to bring 10% to the table. And it's one of the reasons that the program is as successful as it is for a lot of small businesses, if you go the conventional route, if that's even available to you on a commercial real estate deal, you may be looking at 25, 30%. And just even on a $1 million deal, you go from needing to bring $100,000 of cash to the table to $200,000 to $300,000. So basically, you get the borrower ends up with two loans. We structure it in a way where this is seamless for them. It's one. We try to do one closing, and try to keep this pretty simple. But the ultimate structure is this. And so what you end up with on I'll start at the top. Where the SBA loans rate is right now this month, if you had a SBA loan fund this month, it's 5.93%. So 40% of the loan would be at 5.93%. That's on a 25-year fixed rate. So they get a 25-year fixed interest rate loan with a 25-year balloon at 5.93%. That is phenomenal financing when you're only bringing 10%, with any level of equity or leverage, but particularly when you're only bringing 10% to the table. The first mortgage, this is what a bank would provide, or or this is where we step in. We provide a first lien loan. Our rates are right now we price about 7.5%. That can go a little higher, and it can go a little bit lower based on kind of the overall credit quality and dynamics of the deal. But that's kind of gives you a pretty good range of kind of where we are funding our deals. And then we fund most of our deals with a 10-year term. So it's very much a traditional kind of conventional commercial real estate loan. So 25-year amortizing loan, 10-year term. So about 7.5 take or give, depending on credit and dynamics of the deal. So right now, if we were funding a deal today, the borrowers in a lot of cases, actually getting below 7% on a blended rate. So if you take the first lien and the second lien, put them together, that rate, we're seeing loans come in right around 7 and some below 7% on a blended rate when we're funding deals. So phenomenal product for commercial owner-occupied commercial real estate from a leverage standpoint, from a cost standpoint, and from the fact that you get a long-term amortization and you get fixed financing. So that's the structure on the 504 loan. I just got a question. Is there ever a scenario where no equity contribution is required as with the 7A product? There is not a scenario where an equity you always have an equity contribution requirement. There's creative ways to get there. For instance, you can do seller financing as your equity contribution. Now the seller has to jump through some hoops and subordinate obviously to the first and second loan, but there's ways of doing it with less equity creatively. But at the end of the day, the SBA on the 504, you're going to have to show some skin in the game as far as that goes. Just real quickly, eligibility. You guys are probably aware of this because the 504 is on the eligibility side is the same as, well, some of it's the same, I guess, 7A. It has to be a for-profit business. You now have to be a U.S. citizen in order to get SBA financing. And that's really all beneficial owners of the business have to be U.S. citizens. SBA 504, it's really for commercial property. 7A is if you're looking for business acquisition, if you're looking for working capital, that's going to be a better route. But if you're really, your borrower is looking to finance, refinance, or grow, renovate, whatever, commercial real estate, 504 program is probably the best bet. No previous defaults on government debt, and then the big one is it's got to be owner occupied, and the SBA defines that as that the small business that's operating and the borrower effectively is occupying at least 51% of the property that's being financed. So 504 is great for fixed assets. So you got real estate acquisition, you can do renovation, construction, FF&E, leasehold improvements, and some of the financing costs, particularly if you're doing construction, some of the financing costs are eligible to kind of be rolled into the entire project. So that's the background real quickly on the 504 program in general. I know that's probably a review for some of you, you're probably familiar with that, but I thought that was important for those who don't have a day-to-day familiarity with it to just go through that once again. So let me pause there, Scott. I'm jumping to something else. Any questions on the 504 program specifically before I kind of get into really what I wanted to share with you guys today about kind of a sales strategy I think might be interesting for you?
There was another question that popped up. It was, how do you vet the GC if you have to vet them at all?
Are we talking about
for the construction? For construction on the 504. Yeah.
So how do we vet them as a lender, I guess is the question?
Correct.
Yeah, I mean, so we're going to be looking at the contract. We're going to do some basic due diligence. We're going to want to know, kind of what their experience is, some references from past projects. We're going to look at the contract. We're going to look at the plans. Pretty standard stuff. It's not a ton of background. We just want to make sure that the GC has experience and they're credible in whatever kind of project the borrower's taking on.
Great,
any other questions on 504, just generically speaking, that I can answer before I move on?
Anything else out there, guys? Hold on for a second.
Okay.
Is there a list of docs? Hold on for a second. Is there a list of docs we need to grab from the GC when you're doing the vetting?
Yeah, not really. I mean, the biggest thing would be, so you want some sort of, we want some sort of resume, background, references. We're gonna want their insurance, policy, but no, there's nothing really specific beyond that.
Okay.
Yep.
Perfect. Anything else out there, guys, before we move on? Well, hold on for 1 second. Don DeLegge, are you out there, sir? Go right ahead.
Hello, Scott.
Hey.
Go ahead. Hey, Don, go right ahead, sir.
Yeah, so my question, who leads the underwriting process? Is CDC, or do you lead the underwriting process? Or do you have to work underwriting on both ends?
We try to make it as seamless as possible. One of the things we understand with the 504 is with a lot of banks, you're running parallel processes, which is just a pain. So what we generally do, if we're quarterbacking a process, we'll handle everything. So the borrower is just dealing really with us, or you're just dealing with us, and we'll kind of interface with the CDC from there. And so basically it's one underwriting process instead of two.
And you work with any CDC across the country?
Yeah, we've closed loans in, I don't know how many states, but we've closed loans in a lot of different states. So we have some existing relationships with
Yeah.
CDCs if that we would call on. We're flexible. If you have a CDC you work with, like in your area that you have a good relationship with, we're open to working with anyone. We have some opinions on CDCs here or there about which ones are good and easy to work with and which ones are not, which I won't air publicly or anything. But we're flexible if you have a CDC you like, but we also have a lot of existing relationships with CDCs.
Yeah, and so I thought I wasn't sure if I missed it. So the borrower, my understanding is they have to come in with at least 5%. You could have other financing with seller, but they have to be in the game for at least 5%. Is that the right number?
No, I think they can do 10%. It's just the way that the seller financing has to be structured.
No, I'm saying minimum that they would have to come in would be 5%. The borrower, so they could combine that with seller financing.
Yeah, correct. Yes, they can do that. Yeah.
I got you. Okay. Thank you.
Thanks. Nick, are you out there? I see you have your hand up.
Yes, Scott.
There you go.
I was
Hey,
just
Nick.
wondering, doesn't look like there's anything listed for credit rating of the borrower.
Yeah, there is no hard and fast rule. I would say with us, those can be circumstantial. There's no hard and fast rule, but I mean, the SBA is going to underwrite the loan. So if there's some serious credit problems, that can derail an underwriting, but it's situation by situation, I would say, versus, hey, if they have this number, there's no way we're going to get it done. Now, you gotta kind of anticipate if it's like really, really bad, and there's recent bankruptcy, like it's gonna be hard to get it approved. But we see loans getting done that, maybe wouldn't pass typical bank, FICO score requirements too.
And is there a maximum loan amount?
So the SBA loan amount, that 40%, if I go back, that's capped. The second lien loan amount's capped. For most, it's capped at $5 million.
Okay.
The first lien is not. So the bank or us, we can go as high as we want. So to keep the 50-40-10 structure, you cap out at about $12.5 million. If the borrower wants to bring additional equity, or a first lien lender wants to do a bigger loan, they're more than welcome to. You can go higher than that. When you do that, the second lien amount, the 40%, becomes a smaller percentage of the total project.
All right, that's cool.
Yeah, so on 7A, just to remind you, 7A, because you really are capped out at $5 million. That's as large as you can go. But 504, there's no hard cap. And so what you'll see, particularly with bigger projects, and I think one of the reasons so many hotels, for instance, go to the 504 route is because most of them are going to come in above that $5 million cap that you hit on the 7A side.
Right. Great. Thank you.
Yep. All right, good questions. All right.
Go right ahead.
Yeah, so this is, I hope you can see my screen well enough. This is one thing we've been working on when we talk to borrowers directly. I think one of the things that's so powerful about the 504 program is it gives small businesses access to owning their own real estate that maybe have traditionally not, right? They've leased, they've rented, whatever it might be. Maybe it's a restaurant and they've been leasing their space for 10 years. The 504 is a great opportunity to transition from leasing space to owning space. And I think that's a great opportunity for brokers in particular, that if you're talking to small businesses that are, whatever that might look like, that don't own their space, to transition into the 504 program is not only is a great opportunity because of the low down payment, and we think it's a tremendous wealth building opportunity for a business. So as we say, your business, your greatest asset, but for a lot of them, the building they're occupying could be their best investment. And so what I wanted to walk through is an example of how, potentially a borrower that's renting or leasing for the long term could buy their building, get an SBA 504 loan, and build themselves a really nice nest egg over the next decade if they're planning to be in that same property with their business in the long run. So let me run through it. So here's an example. Scott, now not Scott D on the phone, but Scott, let's say he's owned his business for a couple of years. He's operating in, I'll just use a restaurant. He's got a restaurant. He'd love to own the building. His landlord wants to get out, so there's an opportunity to buy the building for $2 million. All right, so there's our hypothetical example. So as we talked about, he would have to bring $200,000 as his down payment. And we're just using this. So let's assume he got a 25-year fixed rate SBA loan at 6.5% rate. Like that's his total amount. And then let's assume over the course of the next 10 years, the real estate that he buys increases at 7% annually. Now that number 7% is about the number over the last 30 years of the annual increase that you see in commercial real estate. So you can discount that some, you could make it more, whatever. We're just using that as an example because that's been kind of the historical average increase in the value of commercial real estate. And let's just assume that his lease payment now would be equivalent to approximately what his mortgage payment would be. Okay, so those are our assumptions. So if today, kind of coming down to my case study, the property, he buys it for $2 million, that's what it's worth. If that property appreciates at 7% a year over the next 10 years, it will be worth $3.9 million in 10 years, right? During that time, he'll be obviously paying principal and interest payments, and his loan balance at the end of 10 years, it will be about 1.3 million. Okay, so assuming the cash outlay is the same, he'll pay his landlord $1.5 million over the next 10 years if he just continues the lease. He'll pay his bank and the SBA $1.5 million, which includes interest and principal payments over the next 10 years. So that's equal. But at the end of the 10 years, whereas in the case where he leases, he doesn't own anything. Let's say he retires and shuts the business down or, moves on, he has nothing there. But in the case where he has bought the business, his outlays are basically going to be very similar over the same period of time in terms of monthly and annual cash flow. But at the end of it, he'll have a building that's worth $3.9 million and a loan that he owes of $1.3 million. So the total equity that would be built over that 10-year period. Now, these are given the assumptions I have up here, so you can discount them if you wanted to, or make them a little more conservative. But I think the point is intact, which is for a $200,000 down payment on a $2 million purchase, that small business owner over 10 years could build up $2.5 million in equity. So you're talking about a 10x return on that investment in the business he's already in. He's already paying every month to be in that building and to lease that space. So we think it's a great illustration of the opportunity for a small business owner to leverage the SBA 504 program with the low down payment to go ahead and make an investment in a fixed asset that's had pretty good historical returns, being commercial real estate returns, something that's tangible, particularly in this economic environment. We think it's a pretty good play and an awesome opportunity for brokers when you're out talking to potential business owners that could be borrowers, that this could be something that you could kind of sink your teeth in and let them know, hey, there's an opportunity here. And we can support you with this. There's some ways we can make this even more, intuitive in terms of explanation. We have some handouts and whatnot that I'd be happy to share with you. But it's a great opportunity, I think, to help small business owners build a massive retirement nest egg. Any thoughts on that, or any questions on that? I mean,
Nope, go right ahead.
anyone?
No other questions.
Okay. Awesome. All right. So let me kind of. Did I hear someone say something?
Nope.
Okay. So hopefully that makes sense. I think it's one of the great opportunities to continue to promote this particular product and leverage it for the benefit of your business. I just wanted to mention a little bit about if whether it's a refi, whether it's a new business like we're talking about, lease versus owner, whatever it is from an SBA or an owner-occupied real estate standpoint. As I mentioned, we're a non-bank lender in the SBA 504 world. Most of the lenders that are just traditional banks, community banks. Who's doing most of the heavy lifting. There is some non-bank lenders like us. What being a non-bank lender for us has allowed us to do is to build a platform where we have flexibility to get deals done. So we see a lot of different deals. We're experienced on how to structure them. We're not necessarily a lender of last resort in that sense, but we can kind of navigate things that most of your traditional bank lenders are not gonna want to deal with. One of our goals is to be as fast as you can go, or as fast as your borrower can go, in terms of moving and getting deals from start to finish. One of the things that I tell brokers all the time is, with some pretty minimal detail and information, I can tell you in a lot of cases, very likely on the phone, whether we'll do a deal. And I can usually have you, if we want to do it, usually have you a term sheet within 24 hours if it's a deal that we want to do. And then once we commit, we're committed. I hate how often in the SBA world, a bank will drag a borrower along for 90 days or 120 days just to tell them, oh, sorry, we can't do this. So if we get in the process and the borrower's been honest on the front end about everything, there's not surprises that they just haven't disclosed, and we know what we're dealing with, we'll get the deal done. And we've done it for a long time. We've been involved in other roles with SBA 504 on boards of CDCs, and involved with the program for a long time. And then as it relates to other non-bank lenders, one of the things about us, it kind of differentiates us in the space from the other guys out there that are kind of similar to us in the sense that they're maybe not a bank and they have some maybe wider credit boxes and whatnot, is they tend to be very expensive. They tend to be priced closer to 7A lenders, a lot of them, than what a typical 504 loan should go for, with a 50% LTV first mortgage. We're very competitive with rates, even with traditional bank financing, even though we're a non-bank lender. And so we try to do that, and then deliver kind of these value propositions of flexibility, speed, certainty, and expertise. So I guess with that being said, that's really kind of what I wanted to share with you guys today. And then I'd happy to pontificate or answer any questions, about what I mentioned about the leasing scenario, leasing versus owning scenario. Happy to follow up on that. Happy to answer any questions on 504, on construction, or anything specific to kind of the way we operate and what we're doing in the space.
Great. Darrell, are you out there, sir? I know you had another question.
Yes. Thanks for sharing that example, or that visual example. I mentioned something about depreciation, using that as an advanced tax savings strategy and an exit strategy, potential exit strategy. Do you have any examples that we could share to take to business brokers, commercial real estate brokers, professional business advisors? We know you can do a variety of niches. However, some people get tunnel vision until they see a like-kind example. Sometimes it just doesn't click.
Okay.
Does that make sense?
Kind of. I'm not 100% sure your question. So, are you examples of what exactly?
construction, acquisition, renovation, before and after, say for instance, they were leasing at this payment. Now they were able to secure their location and have a better tax deduction, whatever it may be, or now they have a 10-year retirement plan, whatever.
I got you. Yeah.
You see what I'm saying?
Yeah, of course. Yeah. I mean, I don't necessarily have any specifics. I guess I would say on that, we certainly, if you have an idea of like, hey, I'm trying to target this niche or whatever, I'd be happy to put something similar to what we did together. I hear what you're saying. I mean, there are with, when you own the fixed asset, you also get obviously the depreciation write-off that you might not get when you own. I think that's what you're alluding to. But I think what you're mentioning about being like a strategic retirement plan, I think that's a really good way of positioning this, right? Because a lot of small business owners, especially if it's just, it can be hard to, run a business and then what's the succession plan, or how do I retire from this and not work my whole life? And I do think specifically for certain commercial real estate assets, like this is a really good way of thinking about, well, how are you investing in your future? And what a better way to invest in it than start stop paying a landlord and just start paying yourself. And then at the end of it, if you get just a reasonable real estate appreciation, it really is a nice way to think about a small business saving for retirement in a strategic way. I don't know if that answered your question, but I think I like the direction that you were headed with that.
Yeah, I do work with advisors in that niche, in those niches, that whether it's depreciation, exit planning, capital gains, and things of that nature. But they typically work with medical and dental practices, surgery centers, trucking, hospitality, and agricultural companies. So I like to use financing to help them accomplish those goals, those exit goals, those growth goals, those employee retention initiatives and things of that nature. So that's why I was looking for specific niche examples so they could sort of see what's possible. Yeah, I mean, it's funny. We have put that together for specific industries where we do the same thing, where we're talking to one of them. It was just more. I guess this is too specific, but like for franchises. So we actually put something similar to what I showed you guys today together for franchise businesses to kind of explain how that might work, where they again go from leasing to owning. I'm sorry, can you repeat that last part, please?
Yeah, I was saying is we have put some industry specific things together, just like you mentioned. We did one this week for a franchise business where we kind of took a very similar example of what I showed you and customized it for that niche.
Got it. Sounds great. I'll reach out to you on LinkedIn. We're connected.
Yeah.
How about industries, Mike? Is there any particular industry you won't work with?
No, we're pretty open. There's some industries where we're a little bit more credit conscious. We really are focused on the real estate collateral in terms of our underwriting, if you will. So, hotels are big. We will do hotels and look at hotels where we tend to be a little bit more. I'd say a little more conservative with very, very high, highly special use properties. But there's no real constraint from an industry standpoint. We do gas stations. We'll do special use properties, event properties, restaurants, hotels, car washes, self-storage, etc.
Excellent. Are your underwriting standards posted on your website for the 504 program?
No, I don't have anything posted. I have a matrix that can kind of give you an idea of how we think about it. But perfect. Yeah, and I can share that. And what I would say is I think Scott's going to share everyone's email on this call. So what I plan to do is follow up with everyone. That's right, Scott, right? You're going to share the emails.
Yeah, I will. I'll share the email. If you can send me this presentation also, I'll
Yeah.
well, actually your email is going to be on here, correct? On this presentation?
Yeah.
Do you have
Yeah, at the end,
a page?
Yeah. So,
Okay.
yeah. So
Yeah, and I'll make sure I can put it in the chat box too.
Okay, great.
Excellent. Larry Grant, are you out there? Hold on for a second. You're self-muted, Larry. I think you had a leasing question about the building. Oh, I can't get you off. Hold on. What is it? It has a question about leasing out part of the building. Oh, I can't get him off self-mute. All right. Let's see.
Yeah.
Ralph, are you out there, sir? Go ahead, Ralph.
Yes.
Go
So
right ahead,
how
sir.
is SBA on hotels now? The last time that we tried to do one, it was a nightmare.
How are they in terms of in terms of what? Like improving
Just,
them or
just
what you underwriting?
just the process. I mean, we've been doing this a long time. We know a lot of the questions are going to be asked before they're asked, and they just make stuff up. I mean, we would go through sometimes 1 or 2 declines before we ever got to a screen out. And then we'd get several screen outs before we would actually get an approval.
Yeah. I think a lot of it, I think they're going to be a little, with hotels, you're going to get a little more scrutiny for obvious reasons. But I think a lot of it comes down to the CDC. So I think part of your experience may be SBA, but part of it may have been CDC specific. Because, and now it sounds like you sent questions back, but the CDC, a good CDC's job is to, try to anticipate those screen out questions and navigate that on the front end. I do think SBA is more cautious on it than maybe other, more conventional property types or whatnot. The highest default rate in SBA 504 is hotels by a long shot, and it's one of the biggest industries. So it's going to be more challenging. I can't speak to, your last experience and how it would be now. My experience with most loans is I've seen it be a real headache, different, not even just hotel loans, even conventional stuff. If the CDC is, not great at what they do, and there's some that they're looking for reasons not to do deals, and there are CDCs that are creative and flexible and want to get deals done, and they operate like a business, and some operate honestly like government agencies. That's just my view. So that's why it's mentioned earlier, for us, we have some opinions in different states where we kind of know if we go this route, it's going to take longer and going to be a little more painful. But if we go this route, we can fast forward things. So don't know specifically, how it's changed since you last did one, but I think it's probably often more of a CDC issue than SBA.
Perfect. Okay. Larry, are you there? I think you're back on. There you go. All right. Go
Can
ahead,
you hear
sir.
me? You can hear me okay?
Yes, I
Scott?
can. Go ahead.
Oh, great. Yeah, I'm sorry. And I could hear you before. It was very frustrating. I know that you couldn't get me off of self-mute. That was weird. But so thank you for giving me another chance. So Mike, nice to speak to you again. Wanted to ask you, so I know one of the advantages, and I don't know if you mentioned this earlier, but it's good that everyone knows, is that you can, as long as you own that 51% that you did mention, you can, rent out the rest of it. But I was curious to know, what happens to a business owner? Let's say they're in there.
Lost him.
Oh, I lost him again.
Yeah, I lost him.
He's still talking. Yeah, he's still talking. Must be a bad connection.
Yeah, and what he was mentioning there for everyone, the 51, as I mentioned, the operating company, the borrower has to occupy at least 51% of the space, whatever the property is. but they can sublease the rest of the space up to 49% to other tenants and have tenant income from there. But I didn't get the rest of the question.
Yeah, he went offline. He must be having IT issues or something.
Yeah.
Do you have any property limitations? I don't think you do. I think you said you're
Any property
open to
limitations?
all proproperties.
Yeah, we're open.
Yeah.
I think some are a little more challenging than others with any lender. But generally speaking, we're open to really any property type.
And then how about broker? What are you paying broker comp? What's the broker compensation?
Yeah, we typically pay 1% out of our closing proceeds after the day or two after the deal closes.
Okay, perfect. Do you have any property limitations? That's it. Any other questions out there while we have Mike? That's some great questions you guys have.
Excellent.
Can you help streamline the process and place deals? I'm guessing with the CDCs, I would imagine that's what that question means.
Can I clarify that?
Yeah.
So
Yeah, go ahead.
what role does Access, and again, sorry if I missed this, are you all funding the first mortgage, or you placing with the CDC and the second lien holder, or like how does that work? Or are you providing funding up front and then being bought out by a first and second lien holder?
Yeah, so we're funding the first mortgage, okay? The first lien I talked about. So just trying to go back to sorry, I messed up. Never mind. So sorry. Stop sharing here. So to answer your question, we fund the first mortgage and we fund what's called an interim note. So when the SBA 504 loan closes, the SBA funds their loan from a debenture sale, and it actually happens after the closing. So there's a bridge gap period of they call it 45 days that needs what they call interim funding. And so we're a typical, like any SBA lender, we fund both. We maintain the first mortgage for the long term, and the SBA takes an interim note for that 40% piece I talked about around 45 to 60 days after the loan closes. So our role in the process, we are the direct lender on the first mortgage. We serve as the interim lender, which you need for an SBA 504 transaction. And we are also quarterbacking the process with the CDC. So if you don't have a CDC or you don't want to deal with them or whatever in the 504 program, we have relationships. So we'll kind of quarterback that process along the way to get that SBA approval so we can get the second mortgage funded, which makes the whole project work.
Perfect, thank you.
Mike, Larry's question was, what happens if the owner retires and wants to lease out the building and the notes called or notes paid off?
They're more than welcome to do whatever they want if the note's paid off. They can do whatever they want.
Or notes called or whatever. I mean, it doesn't really matter, right, at that point?
Yeah, no, and at that point, if it doesn't matter, no.
Okay, all right, good.
What if they want to
Any
retire
other questions?
before the notice paid off?
What's that?
What if they want to retire prior to the note?
Well, I think they can retire anytime they want. I mean, the borrower is the small business. They would still be on the hook as the guarantor on the note. That would probably be the challenge there. But there's no limit to them retiring per se. The other thing you can do is the borrower has the option of paying off the SBA at any time and retaining the first mortgage, or paying off the first mortgage at any time and retaining the SBA. They don't have to pay both off at any point. So that can be part of that solution too. But someone can retire you know, there's no limitation as far as that goes.
Larry was asking if the note was called. So if the note's being called, what's the,
I don't.
yeah, that's probably, meaning
Uh,
probably for covenant violation or failure to pay, and they're calling the note for some various reason. Oh, if he
Yeah.
retires.
I'm not 100% sure I'm following. They're calling the note,
Yeah.
and then he retires or wants to retire. And if they're calling the note, basically what that means is they're going through a foreclosure process on the property.
Correct. Yeah.
They're going, and so that would happen if you were in payment default. It wouldn't stop that. I don't know how them retiring would change that. If the question is, if they retire, will the SBA call the note? You know, I guess technically they could. I don't. I take that back. If they were to retire, and let's say, I don't see any circumstance where I don't understand. I don't think there's any concern there. If they're, whether they retire or not, if the note's getting called, it's because they're not making payments. So the retirement would be somewhat irrelevant to it.
Okay. All right. That makes sense. Yeah, I get that. That makes sense. What else? I think that's it. We got the broker conversation. Is there any prepay penalties?
Yes. Yes.
What's a prepay look like?
Yeah, the SBA is it's a 10-year prepay. It's based on the net debenture rate. So I don't know the number exactly off the top of my head, but it's a declining 10-year prepay on theirs. And it's whatever the debenture rate is that the loan's funded at. It's that, and it declines 10% each year for 10 years. So I'm just gonna, I don't know the exact number, but let's just call it less than 5% right now. So 4 and change maybe. That would be your prepay that goes down 10% each year. That's on the SBA loan. Our loans are vary a little bit. We typically have a 5-year declining, kind of standard 5-year declining prepayment penalty.
Okay. All right. I think that was it. Great questions, guys. Great questions.
Yes,
Anything else while we still have Mike here? Anybody? Bueller? All right, good. All right, very good. All right, guys. Mike, thank you very much. I appreciate you as always. I will get the information of everybody that was on the webinar today, so you can email them directly. And I put your name out in the your email out in the question box, so everybody should have that. Otherwise, I'll make sure they get it also.
And let me, I'm going to put this, that's kind of an old, I have that email, but I'm going to put another email out there. That's my Access Private Capital email there.
Okay. Perfect. He just put that in the chat box, everybody. So it's there that you can take it right out of the chat box too. So everybody hang on. We have Anchor Loans coming up on board next. I'm just waiting for them to get on. They're having a little IT issues. So, oh, there he is. Hey, Mitch, how are you?
Scott, this is Mitch.
Hey, oh, hi, Mitch.
Dude, I'm so sorry. Yeah.
All right, hold on for a second. Mike's just wrapping up, and we'll get you right on. All right, Mike, thank you, sir. I appreciate it.
I appreciate y'all's time.
Have a good one. Bye-bye.
Thank you, Scott, for the opportunity. Have a great day, everyone.
You too. Take care. Bye-bye. Hey, Mitch, are you out there?
I am, yes. Can you hear me?
I can. I got your text message. Did you guys send me the deck? Because I can flip the deck and.
Yeah, I'll do that right now, Scott. Sorry for the trouble here.
No, that's fine. It happens. I can flip through the deck. Just cue me when you want me to flip the deck over, and we'll get you on board with everybody, and we can go from there.
Got you. Okay.
Yeah. Sometimes it's sometimes it's a firewall that blocks everything. It happens. It does happen. So
well, dude, that happens everywhere, man. It's insane. Like I didn't think of it. I thought like, okay, so for people who are on the call, like I joined this company 2 weeks ago, and it's like, you know, there's all these permissions and everything, all this stuff. And Scott, sending this to you now, and I'm like, hey, I'm gonna do a webinar. I got asked to do a webinar, and I'm thinking, okay, it's not gonna be a problem. I just gotta join this webinar, right? No, you know, it's gotta be flagged. So I apologize for the trouble. I'm sending this slide deck over
That's
now.
all right. We get it on board, then I can I'll share my screen so everybody can see the deck. And do you have Mike with you? Mike, are you there?
I'm telling him to call in right now. Hang on 1 second.
All right, that's fine.
All right, everyone there?
Yep, I'm here. Mike, you there?
Mike is dialing right now. I told him to give me a shout when he gets on, but we can go ahead and start for the sake of everybody's time.
Yep, hold on for a second. I just got the, where is it, slideshow from the beginning. All right, can everybody see my screen? Just throw a quick yes in the question box. That would be amazing.
Scott, remember when I used to present in person? Never had these problems. I missed that. No IT issues.
Oh, man. All right, everybody can see my screen. All right, Mitch, I'm going to turn this over to you. We have Mitch with Anchor Loans. He's going to be presenting their program today, and one of his colleagues will be joining shortly, Mike. That might be Mike just that joined us too, but yeah, I'm going to let you gentlemen take it from here. Hey, Mike, how are you? I'm going to let you guys take it from here. If there's any questions, I'll bring them on and let everybody speak with you guys. But I'm excited to learn about Anchor and your program, so I'm going to turn it over to everybody. So go ahead, gentlemen.
Awesome. Well, hey, thank you, Scott, for the introduction and for giving us the opportunity here. Guys, everyone on board, I'm sorry for the trouble with the IT stuff. I'm glad we got something situated here. So Scott, I'll like flag you when to change the slides. And then, just keep me posted on like if there's a time limit or anything when I'm getting close to the end. But thank you guys for the time. The way we're going to go about this is I'm going to go through, present a little bit about Anchor Loans, how we work with brokers, and then dive into some of our programs a little bit as well. As I mentioned earlier on the call, I joined the company a couple of weeks back. I came over from another shop. So I'm still relatively new to Anchor myself. So I brought my colleague, Michael Mina, on as well. So he joined too. He's been with the company a little bit longer. So he's going to present as well and provide some more insights since he's a little bit more experienced with the company. But this is pretty easy going. Scott, I remember GoToWebinar, they might type questions in while I'm presenting. If that's the case, feel free to interrupt me and then just read them out, and I'm happy to answer them. So that's totally fine with me, everyone. But with that being said, Scott, you can go to the next slide to the agenda there.
Yep. There you go.
And since I kind of already talked about this a little bit as well, we can go ahead and flip it to the next one here. So here on slide 3, talk a little bit about Anchor, how we get our capital, who's our ownership. So we work with Pradium, who are a trusted capital partner in the real estate space. And I'm going to use this slide to tell a little bit more about Anchor Loans and what our goal and objective is. So ideally, where we focus is we're a nationwide investment property finance lender, mostly when it comes to fix and flips and ground up construction loans, right? And as I continue throughout the presentation, We'll dive into some of those programs. We'll dive into some of the scenarios that we see on a daily basis, as well as showcase a little bit of what we like to see from our borrowers in order for us to be able to fund them as well. So hopefully a lot of useful information for all of you. And Mike and I will do whatever we can to paint a clear picture so that all of this information, and I'm sure, you know, in these classes, you guys are getting tons of stuff thrown at you. So feel free to interrupt at any time, ask any questions, but yeah, we'll go ahead and get started to the next slide as well.
Ed?
All right, so here we're seeing powering development, right? This is Anchor's objective. So we're looking to empower developers to deliver the future of America's housing. And what we mean by that is when I mentioned ground up construction and fix and flip loans, you know, we want to see more inventory in the space, right? So our goal and our objective is to provide tailored financing, risk-based pricing, and expert-backed strategies in order to finance good, profitable projects for experienced builders nationwide so that they can put more homes out there on the market, right? So that's part of what me and Mike do at the company. We scale, we go ahead and look at every single deal from the ground up, determine whether or not it's going to be a fit based on multitudes of factors, right? And Anchor has been doing this for about 2 decades now, right? We've funded over $19 billion. We've constructed over 53,000 homes. And we cover, like I said, a wide range of the states, right? So we're in 48 states where we lend. I'm talking to you guys right now from Connecticut. I'm in the Northeast, and Mike is actually joining us here from California. So we're on complete opposite sides of the spectrum here, covering different areas, focusing on different avenues and identifying opportunities. And that's where we really try to help brokers in our roles try to identify those opportunities as well so that they can go out, find their own business, and have people like myself and Mike and Anchor Loans in general to go to in order to help get these properties done and make a little money as well, right? That's important. Mike, you got anything else you want to add onto this slide here? Sure.
No, that's awesome. Yeah, I mean, you know, you kind of hit the nail on the head there. I mean, there's, you know, when we do our market research, we see, you know, how big of a housing deficit we have, and I'm sure we can all agree on that, right? Like, at this point in time, we are probably 5 to 7 million homes imbalance right now. And so what that kind of says is we need 1.8 million homes for the next 10 years to keep up, right? And so, you know, once when you take a look at like the big builders, the Lennars, the D.R. Hortons, and all of those, you know, big builders, number one, they can go straight to Wall Street and grab their capital. But number two, you know, they only really build about 300,000 homes a year, right? So when you talk about the delta between 1.8 million and 300,000, who is building the rest of those houses, right? It's these clients that need this capital from us. And so there's a massive opportunity in this space. And we were here to help you guys capitalize on it, right? And provide the debt, you know, the capital for you guys to do that and provide the capital to your clients. So that was my 2 cents.
Yeah, and thank you for adding on to that, Mike, too. And ultimately, he hit the nail on the head, right? We're here to be an asset to you guys and your business, right? Like, when people come to you with scenarios and questions, like, that's where you call me, that's where you call Mike, or email us or text us, and that's where we give you the answers and guide you in the right direction, so that you can bring this like accurate and valuable information to the clients that you're working with, right? That's the ultimate goal at the end of the day. All right, Scott, we can move on to the next slide.
There you go.
Perfect. So this is just kind of segueing into where we're going next. So the Anchor Loan Solutions, navigating current market conditions, and, you know, Mike kind of identified some of these already, right? So we'll go to slide 6, Scott.
There it is.
Yep. So ultimately, there's that need for diversification, right? I mean, I think as brokers, you're trying to, it might make sense a lot of times to try to niche down into one specific space, one specific product, get familiar with one space so that you can kind of be that go-to guy. And there's nothing wrong with that at all. But there is also just something I've always thought in the 4 years that I've been in this industry is just, diversifying and having having opportunities to be able to speak to different lenders, speak to different that offer different programs and products, and have a home for certain scenarios that come across your desk is a huge, huge asset. It's something I think is pretty understated. Obviously, a lot of brokers work mostly on the residential side of things. Somebody looking to purchase their dream home, someone looking to refinance out of their current loan. But with investor-focused loans like fix and flips, ground up, it opens up so many more avenues. It opens up so much more opportunity to bring in more business and honestly repeat business, right? The thing with investors is that they're always going to be looking for that next deal. Some investors are doing multiple fix and flips a year, anywhere between 3 to 10 deals going on in a year is like a perfect borrower for us. If they're doing more than that, fantastic. So there's people out there that are always looking for capital providers like Anchor Loans that are looking to work with brokers who can negotiate on their behalf and introduce them to different types of people in the space, like lenders like us. It's an invaluable asset to have. And Scott, we can move to the next slide.
Sure, there's one question. Darrell, are you out there, sir?
Yeah, sorry about that.
Go ahead, Darrell.
Yes, are you lending on single families only or units? And if so, what's the typical or maximum amount of units you can fund for development?
Got you. That's a great question. And I'm sorry, could you tell me your name?
Darrell Patrick.
Darrell, thank you. Great question. So where we really focus at Anchor Loans is going to be in that single family market. We consider single family to be 1 to 4 unit. So anything in that box is what we're going to be looking at for a deal. We're not really touching anything above 5 units currently, from my understanding. Mike, correct me if I'm wrong on that. But that's our niche in the space, is that single family market. We're trying to add value through the single family homes.
That's correct. Yeah. We might look at up to 5 to 9 units in California, but have to be a very strong borrower with very strong FICO liquidity and experience. But Mitch is right? We want to stay in that 1 to 4 market. There's a massive opportunity there. We want to focus and we want to be targeted at where we're deploying that capital. And we know that that's going to be the most successful space here on the investment side for a little while.
Got it. Thank you.
Does that answer your question?
Oh, and then I think you have to. So on a single asset, we go up to 15 million, right? So that's going to separate us from a lot of other lenders as well. A lot of other lenders, think, have that $2.5 million mark. Some go up to 3 million on a single asset, but we'll go up to 15 million on a single asset. So definitely keep that in mind. That's definitely a huge opportunity there as well.
Awesome. Thanks for the added insight there, Mike. I appreciate that.
Next slide, go right ahead.
Awesome. Are we on? I lost my space. I'm sorry. Are we on slide 7 right now, Scott?
Yes, the current mortgage landscape.
Current mortgage landscape. Gotcha. Yeah. So this kind of echoes a lot of what we talked about as well. Where we're currently at in the space with U.S. mortgages. Over 56% of them have interest rates under 4. 21% roughly of that is below 3%, right? And that's going off that bubble from 2021, 2020. A lot of people really holding on to those low mortgages, right? There hasn't been a lot of needs for the refinances, right? And I think a lot of that is where you started to see a lot of investor-focused activity begin to start. And one of the best parts, I think, this is a little bit of added insight from like working with investors in my time, is investors are a little less rate sensitive. Because we're talking about rate on this slide, I think it's relevant. Especially when it comes to fix and flip and ground up loans. When it comes to fix and flip loans, there's no prepayment penalty. And a lot of times these fix and flip investors, they'll get their properties done in a span of, 2, 3, 4 months even. And because of that, they're going to go ahead and know that they can get rid of the loan early in the stage so that they don't have to pay their interest rate for the entirety of the loan, right? And then we don't really do anything like it, but with DSCR loans, and I don't know, maybe you guys have talked to a lender that's been on here about long-term rental loans, right? But investors are looking at those kinds of loans as well. Even though there's a little bit of a higher rate, you'll probably see 6s, 6.5s currently. It's all about the cash flow and whether or not the property is going to cash flow. So based on that, investors, they look more at the business purpose of the property itself rather than, whether or not it's going to be the best looking, whether or not the kitchen is going to be what they want it to be. So investors just have like a different mindset. So the point I'm trying to make is that there's a really attractive approach to working with investors, right? Their mindset is always going to be focusing on business purpose rather than the emotional side of things that can be the case with somebody looking to purchase their own primary home, right? Next slide.
Yep. Oh,
Okay.
Go right ahead.
Gotcha. So here we are on slide 8, navigating current market conditions. Again, a little repetitive here, but just trying to nail down exactly what it is that we do. We're looking to create new housing developments. These require ground-up construction loans, rehabilitate old uninhabitable housing, and that requires a fix and flip loan. So that's our niche. That's what we focus on. What are we looking for when it comes to getting these loans approved? We're going to be looking primarily at the borrower's experience. And by experience, we mean previous renovation experience. So if they've never done a fix and flip or a ground up construction project before, it's not as likely if at all, that they're going to be able to come to us and get funded. If they have at least one previous renovation project, then we can absolutely have a conversation. But ultimately, the way we lend and the way that we look at these loans is going to be very dependent on 2 factors, and it's going to be the experience of the borrower as well as their credit score. And the way that we do it at Anchor is they're sort of tiered out. So we have certain buckets that's going to be dependent upon how they correlate with their experience as well. If they've done a 30+ projects lifetime and their FICO is a little bit lower, it's still a very attractive deal to us. But ideally, we'd like to see 700+ when it comes to FICO scores. And then if we go a little bit lower than that, down to 620, I believe, Mike, then we're going to protect ourselves more, and it's going to affect that leverage and make ourselves, a little bit more less lenient, I should say, when it comes to the terms that we're offering. Next slide.
Go right ahead.
Perfect. So I like to use this slide here to kind of highlight the automatic disqualifiers for Anchor, right? So, I'm going to beat down the idea that we're investor focused, right? We're going to be looking at fix and flip, ground ups, and then bridge loans as well. So if somebody's looking to purchase a home and hold it for a little bit and ultimately figure out what they decide to do with it, we can help in that case. But it has to be business purpose. If somebody is looking to do an owner occupied home, like something they're going to let me give you a great example here, actually. So if somebody wanted to purchase a home, renovate it, and then live in it, that's an automatic disqualifier for us. It's not a fix and flip, it's a fix and own, right? So we can't help in that circumstance. You know, even though the idea behind it fits what we do, it's a disqualifier for the sense that it's going to be owner occupied, or even if it's going to be a secondary home, like a vacation home. Those situations are automatic no's for us. We won't even look at them. And then on here, it says natural person. I think that's kind of funny. But just like basically anything that's outside of a business entity. So like when I say business purpose, we also need to see an LLC or some sort of business entity on the loan as well. So it can't be in an individual's name. We can do, I would say 95% of the time it's an LLC, but we can do C Corps, we could do joint ventures as well. We just need to see entity docs just to verify that there is a business entity, and that can be done at least by closing of the loan. If it's not in place before, like we can still have the conversation, we could still price out a deal. We just need to know that it's going to be taken care of before it closes. Otherwise, there will be issues. Next slide, please. And then Mike, anything to add on what I've said, or? All right, cool. We'll just continue.
Sorry, I was on mute. So I was on mute. You know, when you were talking about, you know, rehabbing, you know, older homes, when you look at the numbers too, 40 is the average age of homes in the country, right? So they're 40 years old. So a lot of them need rehab as well. So we were talking about, last time we were talking about like new ground up construction, right? But then when we talk about the homes in their current stage now, a lot of them are old and are going to need rehab as well. That's going to also add to your pipeline. A lot of rehab homes out there. Those are your two opportunities that we're seeing on our side that are going to give you that extra edge to your clients, right? Like you guys now are advisors, right? You have now a full suite of investment products where you can help investors build their portfolios. So just keep that in mind as well, that there's a lot of older homes in this country too that need rehab.
Great point, Mike. Thank you for adding that on as well. All right, cool. So we should be on slide 10 here. So Anchor Loans, sorry, computer's a little slow. Anchor Loans, Financing Solutions.
Correct.
So slide 11 now, Scott.
Go right ahead.
All right, fix and flip, fix and hold loans. So we break these down in two ways, standard rehab and extensive rehab. And Mike, I'm going to have to ask you here if you can kind of explain the differences a little bit more for me, and for the audience as well, just to kind of decide what determines whether or not something's standard and what's extensive. Maybe you can give an example as well.
Yeah, absolutely. So your standard renovation is going to be your lipstick, right? It's going to be floors, windows, paint, cabinets, bathrooms, all that easy stuff. When it comes to extensive rehab, we're talking about knocking down walls and adding square footage, adding the number of units to, let's say it's a 2-unit and now you want to make it into a 3-unit. So that's when it really comes into extensive rehab, when we're really changing the original layout of the property itself, and expanding, you know, expanding the square footage there, the living space.
Perfect. Yeah, no, and it makes complete sense, right? It's kind of written in there exactly what it's meant to be. Like you can kind of probably hear about a project someone's talking to you about and determine whether or not it's going to be standard or extensive based on what they're doing. It's an easy thing to eyeball, but always helps to kind of get an idea about exactly what we're talking about. So thank you for that. We'll go to the next slide here. So fix and flip loans on slide 12. So Mike mentioned a little bit earlier what we'll go up to when it comes to loan amounts. So you can see there it's A 15 million is the maximum we'll go up to, which I think sets us apart a little bit in the space, being able to go up that high. But also 100K is going to be our minimum loan amount as well. And when we say loan amount too, we're talking about the entire loan amount, not just what's lent on the property. So when it comes to fix and flip loans, right, you know, there's going to be, you'll see 90%, up to 90% of the purchase price, or up to 100% of the rehab costs as well. So we're talking about the total amount, not just on the property, but also what is going to be done for rehab as well. That's also included. So you're not going to see too much, you know, when it comes in below 100K for a loan amount in these types of loans. But there are certain areas in the U.S. where that has happened. And unfortunately, we can't help with those. But going up to 15 million, as Mike has said, it sets us a little bit apart, gives us a little bit more wiggle room, and a little bit more an advantage on those bigger projects as well. So to break it down, 1 to 4 unit residential properties, you only pay interest on the funds that are drawn. So the way that these typically work, and it's similar with ground up construction as well, is that we fund the rehab in a draw reimbursement style format. So there's a total loan amount. Borrower does some amount of work on the loan, on the property. They submit a draw request, and a third party, God, not an appraiser. I always forget this word. Inspector usually goes out there and looks at the property, verifies that the work has been done, and once there's confirmation that that's been the case, the amount that's been requested gets reimbursed to the borrower. And so you only pay interest on the funds that are drawn. So, you know, if somebody has a project and they say, hey, I'm going to need 50,000 for this rehab on this property. But, you know, things happen on these rehab projects, right? Things can kind of, you know, go a little bit haywire, or issues can come up. So maybe he thinks, okay, I'll make it 60,000 just to give me a little bit of a buffer. And that's something I always recommend. And I think Mike would say the same, you know, because you're only going to be paying interest on the funds that are drawn. So if you have 50,000, if you have 60,000, you only end up using 50, you're not going to be paying interest on that initial 10 because it was never given out. It's just, we just hold it, right? So it's always a good way to kind of protect themselves as investors. And I think it's good advice as brokers that are having conversations with investors to be able to kind of relay that, right? You know, like, it's our job to advise you, and then it's your job to advise your clients too. So, you know, making sure you understand how lenders like us work, and you know, we'll go into it a little bit later too, but like, we provide training for that. Is I think it really sets you apart. It makes you an expert, and makes you somebody that your clients can rely on. And then if there's something that comes up that's a little bit more nuanced, that's where we come into play. We're meant to be extensions of you guys, right? Already mentioned this, no prepayment penalty. And that's something that I think is very important to relay as well, right? That's pretty standard in this space. Next slide, please, Scott. Talk about bridge loans a little bit.
Yep. We have a couple of questions before that. I know Darrell had a couple of questions, but before that, can you guys do the lot financing also with the project?
The lot financing.
So we'll do the purchase of the land itself, but there needs to be a construction component. There needs to be a construction component connected to it. Like, we're not just going to fund land. So they need to show that they've had, you know, some experience in that area, that they've done a couple flips in that area already. Like, it's gotta make sense.
Yeah, I got it.
And it has to be entitled, and it has to be permitted before we can release our first draw. So, for instance, like, if they buy the land, they're going to have to entitle it themselves and get that, but we will put that into their cost basis.
Okay, perfect. Excellent. Thank you, sir. Darrell, I know you had a couple of questions. You want to jump on those, sir?
Yeah, so when a developer is going to finance construction of multiple units, let's just say 1 to 4, do they need to sell it to a different end investor, or can they own the investment through a related entity?
Do you mean if they purchase the property and then refinance out of the rehab loan into like a DSCR, something to like exit that?
Right. So let's say it's a ground up construction, not a rehab, but they have a lot and they're going to build a fourplex. Can they, and they're not going to occupy it, can they own the property?
Yeah, so they'll refinance it into a DSCR loan or something similar, right?
After
A
construction.
debt service coverage ratio loan.
Yes.
To put renters in there, correct?
Correct.
Yep, more than one. Yeah, absolutely. That's called the Burr method. Yeah, people do that all the time. Well, not the Burr method, but if you're a ground up, yeah. But yes, absolutely.
Okay, so you guys can finance. That's okay. Okay, got it.
Oh no, we have our sister company who we can put you in contact with. That they're called Deep Haven. We'll get you referred over to them or whoever. If you guys want that, please reach out to me or me or Mitch. And then if you guys want that, we have a takeout lender called Deep Haven, who's our sister company.
Right, but you guys can finance the construction.
Correct.
Correct.
Got it. That's okay. And then
Yeah.
are brokers paid on the total loan amount up front, or as the borrower draws funds?
Total loan amount up front.
Got it. Thank you.
Great. Don DeLegge, I know you had a question. You want to take care of that, sir, or jump on?
Oh, yes, I am. I'm here. Hi,
Go right
guys.
ahead, sir.
Yeah, so I see down there it says interest payments can be included. Does that mean you work them into the loan and you're deferring the interest payments till they exit?
Sorry, what was that question?
So I see on your slide, the very last time says interest payments can be included. So
Yeah.
are you working the interest, you're deferring interest payments, working it into the loan?
Yeah, so if there's room in the loan, we'll put an interest reserve in there, and Anchor will pay 85% of that. So technically, they're paying a little bit up front, but then they won't have interest payments for however long we're able. 3, 6, 9, 12 months, depending on.
Do you ever roll the closing costs into the loan?
No, unless it's a refinance and there's room, no, and that's rare.
Okay, and then lastly, how about there's like 8 states where you need licensing? Do you guys carry the licensing, or do we actually, like California, we need an NMLS license if we're financing a property out there?
You need an NMLS. You need an NMLS in those states. You can always refer the deal to us if you need to.
Say that again.
Any state that requires an NMLS, you will need an NMLS.
That requires,
but if you get a deal in a state that requires one, then you can still refer the deal over to us and still make a little bit of a commission on it, but you wouldn't be like brokering the deal all the way through, like handling the doc collection or anything like that. You would just kind of be referring it to us, and then we would pay you out like a referral fee. And anything that those people close with us, they're still connected to you, so you would get those points on the loans that continue, if they continue to work with us, if that makes sense.
No, it does. Got it.
Perfect.
Thank you.
Yeah, of course. Any other questions before I move on?
Nope, that's it for now.
All right. I like the questions though, guys. A nice engaged audience. Me and Mike are loving this. Keep them coming.
Let's see. Next slide. Go right ahead. Investor bridge loans.
Oh yeah. So we do, I know we've mostly talked about ground up construction, fix and flip loans. And that's mostly because that's just a majority of what our volume is and what our focus is. But we do some bridge loans as well. Bridge loans, you know, they're essentially kind of there to help investors kind of seize an opportunity and just navigate a transition with ease. So, you know, if there's a property that comes up where they kind of want to, you know, just make sure they secure the property, but they're not entirely sure what they're going to do with it, you know, if they're going to end up rehabbing and flipping it, or if they end up wanting to hold it, but they just don't want to kind of see an opportunity slide past them. You know, that's a situation for an investor to use a bridge loan. So that's something that we offer as well. It's a little bit higher of a leverage that we offer, or a little bit lower of a leverage we offer, a little bit higher of a rate. But it's just kind of like something that we offer to be able to help investors, move quickly on something, since, markets can be competitive, and, making sure that they want to do what they can with it, right? And then we'll go to the next slide. So we'll give a couple examples of it on the next slide. I think this is great. This kind of showcases an example, or a few examples of where these loans might come in. So are we on slide 14?
We are, yes.
Perfect. So acquisition and entitlement. So an investor is looking to buy land and needs time to get it entitled before breaking ground or refinancing. Recapitalization. Investors using a bridge loan to pull out equity from a property with increased value, perhaps to fund another project or pay off a partner. Or stabilization. So allowing investors extra time in order to find long-term financing. So these are just, I would say, the most popular examples of where bridge loans come into play. I personally haven't seen too many of these scenarios come across in my time in the space. Mike, I don't know if that's the same for you, but it's a nice thing to have, but our focus is really on fix and flips and ground up construction. So, but we're always happy to get an investor out of a pinch and help them out however we can.
Hey, Mitch, what is the, is it a 65% on the bridge loans?
So actually it's on the next slide. So on bridge loans, we'll actually go up to 80%. Yeah, I know. The guys are getting ahead of me a little bit. I like it. All right, so we'll go up to 80% LTV. Yeah, so we'll go up to 80% LTV. And we'll go up to 80% LTV, but everything is really going to be case by case. It's going to be affected by a credit in most cases as well. But yeah, again, it's meant to be a little bit of a flexibility. With the higher leverage, there may be a higher rate, just because I would say most certainly there would be, just so we can protect ourselves a little bit more as a lender. But it's a great point to kind of make here, and I think Mike would agree, is in any type of these loans, whether it's a bridge, whether it's a ground up construction, whether it's a fix and flip, you can never ask too many questions. Especially and when I'm talking about this, I'm talking to the borrower, right? We want to know as much as we possibly can about the deal up front. If there's going to be any situations that could come out and be problematic, it's easier for us to know beforehand than it is for us to find out halfway through the loan, because then it wastes everybody's time, it causes problems, it costs people money. So I would just use this to kind of be like, hey, give me as much information as possible on this loan, what your plan is, what your exit strategy is, because the more you give me, the more I can give to the lender, and the easier this will be for all of us. Would you agree with that, Mike? I think that's a very important thing to remember as a broker.
Definitely agree with that. Yep.
Oh yeah. All right. So then we'll go on to ground up construction loans, slide 16.
Yep. Go right ahead.
How am I doing on time, Scott? I'm probably halfway through the slides currently.
You're fine, man. We started late, so you're good.
Gotcha. I appreciate everyone's patience once again. So now we're talking about ground up loans. So individual homes, 1 to 4 units on a single parcel. Those are going to be the main factors for us. And then on the bottom there, it does state multiple builds on a separate parcel can also qualify. That is just going to be a case-by-case situation for us, wanting to make sure everything's in place. Also, another thing to mention too, when it comes to how we look at parcels, if it's 2 units but they're 2 separated units and they're on the same parcel, that's totally fine for us as well. It doesn't have to be just one standard 2-unit build. I just like to differentiate that and kind of mention it because it is a question that does get asked pretty often. Next slide, please.
Go ahead.
Gotcha. All right, so this dives a little bit more into how we structure our ground up construction loans. One of the things I love about this industry is all the acronyms, right? So we have up to 85% LTC, so that's loan to cost, and then 70%, up to 70% of the LTARV, which is loan to after repair value. So the value that we're expecting the property to come into based on the appraisal. Those are a couple things that we're going to look at when it comes to these loans. Same loan numbers that we're looking at with fix and flip, so there's no difference there. 100K minimum up to a $15 million max. Same type of properties, 1 to 4 unit, only paying interest on the funds that are drawn. So the equity in the land, use it equity on the project, all pretty straightforward, I would say, right? Structured very similarly. Mike, is there anything else that you want to kind of talk about when it comes to ground up, or?
So, we do it a little bit different too on the ground up construction. We're only loan to cost, so there's no real AR or LTV, right? Like we will take the total loan to cost, and to let you guys know too, like we use everything, origination points, all of that stuff. So we take all of that into consideration. Some lenders don't, or most lenders don't. So just keep that in mind. What we do is we'll take that 85% of the total loan to cost, we'll back out the rehab, and whatever's left over will be that initial advance that we're able to give them. So keep that in mind. Another couple of things that we need is at least 2 experiences on ground up construction. So we can get around that sometimes if they have an experienced GC, but then we have to get some documents signed, and then we have to prove with contracts and stuff like that. So that gets a little bit difficult. So not the easiest route to go, but there's an option there. So just kind of keep that in mind. 2 gets you the best pricing, 6 will give you, 2 gives you good pricing. The 6 previous roundups gives you better pricing. And other than that, nothing to add on ground up.
Does do the requirements change if the borrower is using a GC?
No, doesn't change. If he's using a GC for his experience, the GC would actually have to come on the loan with them and go on to the entity. So that's a big one. And not a lot of people like to do that, right? Because the GC has to sign for the loan itself. But then it gets a little tricky.
Yeah, understood. Thank you.
Awesome. All right, so we'll go to the next slide here.
Yep.
Cool. And then this is a little bit of a case study slide here. Not exactly how I would have gone about creating this, but I'll remember that for next time. Sorry, I just joined the company picking out this presentation, but so basically, John Doe, real estate investor. Quick little summary of the project, right? Purchased distressed property for $400,000. Is putting in $100,000 in renovation. Sold it at $600,000. The loan officer's role here is, we're providing a fix and flip loan app for a loan for an acquisition and a renovation, securing a mortgage for the end buyer, and then the outcome is 2 loans closed in 6 months, increased commissions, satisfied repeat client. Now, I'm going to add on a little bit to this here because I don't think this paints like a full picture, but ultimately what we're trying to do, and I've talked a little bit about, and Mike has too, our roles and how we work with investors or work with brokers, and how brokers work with investors. So essentially what this is trying to showcase is, this person came to you. Here's how I would have done it, right? John Doe comes to you as the broker, wants to, get in touch with the lender that is looking for he's looking for this property. It's $400,000. It's distressed. He's putting money into it and he's selling it for $600K. That's what the after repair value is expected to be. So us at Anchor Loans, we're providing the capital for this, right? You guys as brokers you're providing, loan documentation, you're providing terms, you're providing all the information needed for this borrower in order for them to feel comfortable about moving forward with the loan. You're negotiating on their behalf. You're doing your job to get them the best deal possible, right? Now, they're also they're relying on you to be transparent with them in these situations too. They're relying on you to look out for their best interest. And that's the same approach that Mike and I take in our roles as business development managers here at Anchor. We're trying to get you guys the best situation, set you up for success so you can set your clients up for success. And that's how you get satisfied repeat clients, right? So we want a fast and secure close. We want a lot of things to be very organized. And as you work with us and you learn our processes, you realize how much efficiency is going to matter and the documents that we are going to need. You'll get familiar with that. You'll realize how we work with investors and the types of solutions we offer them. And as you build that relationship, that's what leads to the satisfaction and the repeat business, right? And I mentioned earlier on in this presentation, that's the allure of working with real estate investors, is that they are repeat clients, right? So, John Doe does this flip, he sells it for a profit. He's already asking for his next deal. He's already looking for his next property, right? So it's quick, it's fast paced. And that's really what we're trying to do here, is we're trying to offer solutions to investors for them to continue to work with us, work with you, and build sort of a 3-level relationship here, right? That's the end goal. So next slide, please.
Oh, wait a second. John Doe, go right ahead.
Were you on the John Doe slide before?
No, yeah, I was. So I'm on the Anchor Loan Solutions.
Yep, just the borrower one. Perfect. All right. So now we're just going to dive into, what we're looking for with borrowers, right? And what you as brokers should be too. So we'll go to slide 20.
Yep.
And all of this is, pretty straightforward, and I would think pretty common sense, right? We ideally, we would love experienced real estate investors, home flippers, home builders, buy and hold investors, right? And we would love these guys to do 10, 20, 30 homes a year. Like that's ultimately like, the best possible scenario for us, right? But, those are whales, right? So we also want to just see experience in the sense of, they've done 3 deals in the last few years or so. Like we're going to consider that experience as well. And where I think Anchor does really kind of set itself apart, at least from previous shops I've been at, is that, we still count a lifetime experience when it comes to getting these projects funded, which not a lot of people do that. They're really going to only be looking at the last 3 years. At least that's what I've experienced. But Anchor's willing to look at lifetime. And there's been times in previous places I've been where, somebody's flipped 20 homes in the early 2000s. They come back, it's been 20 years, right? I get that. But like clearly they know what they're doing. They have the resume for it. And we'd have to treat them as like a brand new borrower, like from the ground up, right? Here we can still look at that and take it into account. Now, I will say, we still are probably going to put more emphasis on most recent experience, right? Like we would love to see them do at least a few deals in the last couple of years, just because markets change, projects change, things like that matter to us. But the fact that we can still go back and look at what somebody's done, 5, 10 years ago, and as long as they can provide us with, proof that they've done these projects and they're in a LLC, and those are all things that we can definitely take a look at. So I think that's really important to note, because it is something a little bit different than what others in the space have done, at least in my experience. We're going to mention again, no owner-occupied properties, and it must be in a business entity. But talk quickly too about what our solutions are designed for, right? It's a lot of repetition in this, but it's good. It means you'll remember it. Property acquisitions, light to heavy renovations, bridge financing between projects, and then ground up construction. But that's ultimately where we're going to be looking. And then on the next slide, we're going to have an example of like an ideal borrower and what we're really looking at. So on slide 21 here, we're going to kind of showcase exactly, you know, what we look for in a borrower, and this is kind of meant to guide you guys in like the direction of, okay, what does this person's experience look like? What is the lenders I work with, whether that's Anchor or whoever, what are they going to be looking for? What's important to them, right? So you have Jess Torres here, experienced real estate investor based in Phoenix, right? Business entities there, track records there, six flips in the last 3 years is fantastic. We love that. And like I said, anything above 3, that's perfect for us. But even, I do want to state too, even if they've only done 1 or 2 in the last few years, or even like 5 years ago, we can still absolutely look at that too and still work with the borrower. That's not something we would turn away.
I want to call. Oh, sorry, guys.
No, you're good, Mike. No worries. And then the loan purpose here. Mike, I know we did get started a little bit late too, so if you had a meeting or anything you had to jump to, you know, feel free.
Yeah, I'm gonna have to jump here in a second. Are you guys? Yeah, and no, I do actually have to jump. It was great to meet you guys. Thank you guys so much for having us, and thanks, Mitch, for setting this all up as well.
Yeah,
Thanks,
absolutely, Mike. I appreciate you jumping on. And
Cheers.
Thank you guys for being understanding as well. Mike took some time out of his day to jump on with us, but since we got a little bit of a late start, he was a little bit crunched. So just wanted to be respectful of his time too. But either way,
Thanks,
Jessica here. Yep, thank you. So Jessica here, right, she's looking at a distressed property, plans like light to moderate renovations before selling. So again, light to moderate renovations, we're talking about, you know, painting, floorboards, you know, like nothing too crazy, just kind of like mostly cosmetic work. You know, nothing that's requiring a gut job or anything. So, you know, definitely a little bit more of an attractive deal for us as well. They need fast funding, complete renovations, and bridge to resale. And then there's all the check marks on the bottom, right? Meets our profile, has experience, property's not owner-occupied, business entity for transactions, boom. That's perfect for us. Not a single red flag there that could jump out. They have the experience, they have the knowledge, they have the property picked out, and they have the business entity. Great, we can work with this person. So those are multiple different things to be looking at when it comes to what an ideal borrower is, and you know, whether that's, you know, Anchor loans or another lender who offers programs similar or even different to ours, because there's plenty. And I do want to mention as well, there are situations all the time where people come to us with a project and it doesn't check our boxes. I want to reiterate to you guys as brokers, you know, if that's the case, or if you're just not sure, you know, if we can help, still send it over to us, you know, send it to me, send it to Mike. We'll take a look at it. We'll walk through, you know, the situation, whether it could be something we can do or whether it's not going to be something we can do. And then if it's not something we can do, we have no problem, you know, making an introduction to someone who can, even if, you know, if we have a resource for it. If we don't, we'll still try to help. But I have no problem trying to find a solution for you guys. At the end of the day, our job is to help you as brokers, help you grow your business, and make as many introductions as possible to get you guys off to a fast start and continued success. So please don't hesitate to reach out for any sort of situations. I'm always happy to make an intro, and I think Scott would tell you the same. We've been working together for a while, and Scott's the same way. He'll help you guys out there. Next question.
Perfect. No other questions right now. They're looking for your contact information when you guys are done, so I'm guessing we can get that out. I'll get you the name of everybody that was on the webinar today too, so you guys can do a thank you email once you get everybody's contact information.
Oh, that would be fantastic. Yeah. And Scott, I'll just shoot you over an email. Well, you have me in Mike's emails. You should at least.
Right.
So you please feel free to share those. But I'll make sure I send you over my cell as well.
Yeah.
So I'll follow up with you
Before you
after
go
this.
on for a second, Mitch, this is being recorded. If anybody wants a copy of this presentation, I have it. Just shoot me a quick text message or email, and I'll make sure you get everybody's email from Anchor also. Go ahead, Mitch. I didn't mean to cut you off.
Not at all, man. Anytime. But yeah, we'll go to slide 22 here.
Yep, go ahead.
Yep. So this kind of piggybacks a little bit as well off what I mentioned earlier. Just you can never ask too many questions. So this slide is meant to kind of be a guide as to like, here are some things that you should always ask. If you have a conversation with an investor, whether it's through phone call, social media, or even just like a local meetup, right? They come to you with a scenario, here's where we'd like to kind of see. These are some good preliminary questions, right? Is it going to be owner occupied? If they say no, great. Where's the property? What is the borrower's ideal credit score? And I'm going to go ahead and kind of like get this out of the way as well when it comes to credit score. A lot of times when we price out our deals, these are business purpose. So we'll do a credit pull when they actually submit an application and want to move forward. We don't want to pull their credit before they've committed to working with us. And the reason why is because we don't want to ding their credit. So when we do pricing, and when you guys would send over the information that we would need in order to run a quote, which is just a bulleted list of like property and borrower information, it's going to say credit score. We're asking for basically a rough estimate of where they believe their score is. So it can get a little bit dicey. So it's on kind of us at Anchor to really set the expectations of like, hey, we're running the terms based on what your credit score is that you're saying it is. But if it's different than that, it's going to change the terms. So just to be prepared for that, make sure that they're sure that they're where they're at. So if they tell you that their credit is 720, like that's going to look really good for us. But then if we come back and pull their credit and it's 680, still do the deal. It's going to change the terms a little bit. And that's a bit of a big swing. So that's something I always want to like mention to the brokers I've worked with is just set the expectations, make sure that they understand how we work. Because again, we're kind of doing them a favor by not pulling their credit before they move forward with us. But when they do want to decide to move forward, we're going to, and we go off a tri-merge report. So it's usually the middle score that we take. So I think that's just important to cover. Wanted to just mention that myself. But then, other preliminary questions, the business entity, how many flips have they done? Obviously very important stuff for us. And then if they wanted more of a deep dive, which again, more questions, the better, more we know, the better. What's their exit strategy? Are they planning to hold? Are they planning to sell? What's their purchase price or current value of the property, excuse me. And then what are they expecting the after repair value of the property to be? And again, you're kind of taking them at face value with that. Ideally, they'll be going off of comps from the area. They'll be experienced, so they'll kind of know exactly where they're going to be at. But ultimately, after repair values can always come in a little bit higher than they predicted they would, and that's a great scenario for an investor. It means they make more. But so you'll kind of see them quote a little bit more on the conservative side a little bit too. But ideally, we would like to see like a 15% profit, like at minimum for a flip. So that's something to keep in mind as well. If they're going to be, if it's a $300,000 property and they're putting $50K into it and then they're going to sell it for $375, it doesn't really make sense. Like And we'll tell them that, and like you as brokers will tell them that too. Like, hey, I don't think you're going to be making the returns on this. I don't think it's worth your time. I wouldn't want to waste your time. Maybe we wait for the next one. And that's kind of the hard part of the job, but it's also like necessary, is to be transparent with the borrowers, tell them whether or not the deal is going to work, why it isn't going to work, and then help them find a solution, right? Next slide.
There you go.
Awesome. So this is just kind of like what our product matrix and program requirements are, but in like what our PDFs would look like. So we would send these out to you guys to have, and it's basically just kind of like a guide and showcases the buckets that we're looking for that's important to us. Again, this is really repeating a lot of what I mentioned throughout the presentation, but just kind of showing it in a different format, right? So, after when we like when you connect with me and Mike after this call, we'll have these available to you guys. We can send them out to you just so you have them. You're able to kind of see a lot of what I talked about in this in the format that we send out to brokers on a regular basis. And then if there's ever any adjustments made to these programs or any sort of changes, we just update that and then send them out to our network as well. So it's very easygoing and a very helpful tool to have as well. But again, just kind of reiterating a lot of the program info I've talked about throughout this presentation. Next slide.
Anchor Loan Solutions, the loan. There you
Correct. Yep, and we'll move on to 25. We're
Okay,
just
go ahead.
Yep, and we're just about wrapping up here. Only a few more slides, guys. I appreciate you sticking with me here. But these next ones should be kind of quick hitters. So this is just the life cycle of a loan. So it's a new loan, initial underwriting, processing, final underwriting, approval, loan docs drawn, and then funding, and then loan, right? It's just kind of a visual representation of what our life cycle is. And I just noticed I forgot the other C in life cycle there on the top. So I'm going to adjust that for the next time I have to present. But you get what I'm going for. All right, next slide.
All right, there we go.
Perfect. Long bulleted list here. Phew, it's a little intimidating. But we got a comprehensive needs list here. These are all kind of like factors and docs that we are going to need for these construction loans. Property address, product type. I'm not going to read every single one, but this at least gives you a visual representation. But ultimately, Mike and I and our team, we would kind of vet the deal, price it out, send out a term sheet. Once the term sheet is going to be accepted by the borrower, then it would be signed. When it comes to these loans, we obviously want to see a rehab budget. It's marketed here as a budget breakdown. It's about halfway down with a 10% contingency. We want these to be as accurate as they can possibly be. I think that's going to be ultimately the biggest factor when we're looking at ground up loans as well as fix and flip loans. We want to see very specific line items, right? We don't want to just see countertops. We want to know if they're granite countertops. Small little details like that can really go a long way, and it kind of saves time, frankly, a lot of back and forth, because if you get me as much as I need up front, I can pass it off, and then boom, great, we're ready to go. But if I have to pass it off and then they come back to me and say, we need more specifics on this budget breakdown, can you do this? It's just like, the constant back and forth. You guys know how it is. Just trying to, and it's going to take some time to really figure out exactly what we're looking for, right, as you work with us. But once you get it and once you understand it, the whole point is that the process becomes seamless and you're almost on autopilot, right? That's the goal. And eventually, like, you guys will absolutely all get there, no question, because the more you do this, you really get it. But it looks like a lot more than it is on this needs list. I'll tell you that right now. Next slide.
Wait a minute. There you go.
Benefits for loan officers. Perfect. So
Correct.
awesome. So repeat business, right? Like I've mentioned, there's opportunities to finance the investment property and the end user mortgage. So kind of two birds, one stone. And then, I don't think we've talked about like points or commissions or anything yet, but as Mike mentioned earlier, we pay them at closing, and it's usually, I would say by default, it's going to be around 2 points, so 2% of the loan amount. I think it kind of depends on how large the loan is in certain cases, but I want to say that it's going to be 2 points for the most part. But again, points are always negotiable. When we quote them out, that's what it's typically at. But if there's any changes or adjustments that need to be made, that's something that we're always happy to work with you guys on as well. And then next slide, please.
Yep, there you go.
Gotcha. And then this slide is, this is a little bit of a very salesy slide here. At the end of the day, I believe, and I think, my company might not like me saying this, but at the end of the day, I think you should talk to as many people as you possibly can. I think you should talk to as many lenders as you can, get familiar with how they work, get familiar with their processes as well. So you always have a home for a scenario, and you can always help your clients. This is just kind of meant to highlight a few of the things that I think Anchor does, that Anchor does do. Compared to a typical competitor. I don't really like that term. I think typical competitor is like, a little bit vague and broad. But I can tell you firsthand, there's a lot of great lenders in this space, a lot of great people that do a lot of great work. Anchor Loans, like I mentioned, really specifies in fix and flip and ground up construction. There are lots of competitors that do long-term rental loans that specify in that. Anchor Loans does a lot of 1 to 4 unit investment property financing. There are a lot of lenders that do 5+ unit, and that's really their bread and butter and their niche. So that's why I think it's important to talk to everybody, have as many conversations as you can, make as many introductions as you can. I can't stress that enough. But yeah, this slide will really paint a little bit of a picture of some of the things that I think kind of highlight Anchor a little bit in the space. I think I already kind of talked about the big one really being the borrower experience, how we can use lifetime experience as something to look at. That's just one thing that comes to mind that I think separates us a little bit. But as far as programs, as far as process, I think it's something that's been a big focus for Anchor, something that they really want to narrow in on. And with the fix and flip and ground up market, that's where we're really making our headway. So we're going to end up wrapping it up. So I think if you just skip to 30, because 29 is just Anchor Loan wrap up title slide. So yeah, it's just going to highlight a few takeaways.
Key takeaways?
Okay, yeah, exactly.
Cool. Got it.
Cool. So this is what I hope you guys got away from this presentation, along with some other things as well. I'm going to kind of paraphrase a little bit here, but I hope you guys found it valuable info. I hope I painted a picture as to how we work in the space and what my role and Mike's role at the companies are. I didn't mention it in the beginning, but like our job is really, even though we're business development managers, our focus is on the broker market. Like that's who we work with. That's who we specialize working with. And we offer like the tools and guidance to try to help you guys really build and grow your business. And we also have a really great training team too that are going to kind of set you up for success. So those are all things that I recommend as well. When you get set up with us, we have a great training leader named Misty who takes you through multiple different avenues on how to get onboarded, how to get set up and get off to a fast start with Anchor. And then on top of that, there's always other things she does as well, in how to build your business, how to scale, and then also how to go out and source leads too, which I think is incredibly invaluable. And it's all just kind of things that, again, I think are pretty, commonplace. I mean, social media is huge now, but I would say one of the biggest questions I would get whenever I was on the road or presenting, for Scott back in the day was, how do I find leads? How do I find people to work with? If you don't have an established network, obviously social media is huge, but I'm still big on local investor meetups. They happen in every city. I mean, I'm in Connecticut. It's a small state, but these pop up everywhere. I'm sure everyone in this call is in different areas of the U.S. too. But these are so accessible now, and I think the internet has made that the case. And then asking for referrals, asking friends, if they know anybody who does investment properties. I mean, I can't tell you how many cards and conversations I've had just by talking to somebody at a family party or at the bar on Friday night or something, right? A conversation can lead you anywhere. So I'm still a massive believer, as great as social media is, the in-person approach is huge in my opinion. But yeah, hopefully that gives you a little bit of an idea of some ways to kind of get and source some business as well. And then the next slide, I think, is just a question slide, or is that a slide with my friend Ben on it?
It is resources.
Is it
Contact
resources?
Okay.
Okay.
Yeah, Ben is on there. Yep. Ben is
All
there.
right, yeah. So that's my buddy Ben. Ben's not on the call right now. It's me and Mike, but Ben is an incredible dude as well. He's got his nice professional pic up there. Sorry you guys can't see my face. But I have a professional picture too somewhere. And then, but these are just on the left side of the screen, you could see some of the resources, right? Like contact the Anchor Deal Desk. These are just some kind of things to highlight some of the things that Anchor does, and also just makes us more easier to contact as well. But like I mentioned earlier in the call, Scott will get you my info. He'll get you Mike's info as well. And then we'll also be sure to reach out to everyone individually as well, just to thank you guys for taking the time with us. And then I talked a little bit already about the other resources. So like the branch training, sourcing, Power Pulse events. I'm going to be honest, I don't know what those are yet. I've only been here 2 weeks, bear with me, but it sounds cool. Power Pulse. I mean, I'm guessing it's just kind of like a small little webinar get together with brokers. But that's the first thing I'm doing when I hop off this call, is reaching out to my colleagues and saying, hey guys, what's the Power Pulse? What is that? Talk to me. And then the webinars on demand as well. So those are things that I mentioned our trainer Misty does. And she's unbelievable. She makes difficult things sound easy, which I think is a real skill, especially in this industry. And then next slide, I think, is just kind of questions. And yeah, I mean, I'll do the best I can to answer any more questions. It was really nice to have Mike there to back me up since he's been here a little bit longer. But if we have some time, Scott, please feel free to fire away.
So when you do credit, is it personal or business? When you're pulling credit for the contractors.
So it's going to be personal credit. It's not business credit.
Okay.
So we'll have a majority guarantor, a personal guarantor, excuse me. And that's who we'll run credit for. And then as long as everybody's in, anybody that's also 20% or more in the in the ownership is going to be subject to a background check as well. But it's a good question, because sometimes there may be multiple guarantors on the business, and one of their scores is maybe not as good as another one's. So whoever is going to be the personal guarantor, that's who we'll run it on. So they'll just kind of have a conversation like, hey, your credit's 740, mine's 620. Can you personally guarantee this? Cool. But that's typically how it goes. Great question.
Cool. And then, do you guys have a like a minimum credit score that you're looking for? I know you said 680, that was the number on the slide, but is there a
Yeah.
rock bottom score that you'll?
Yeah, good question. So
Let you know.
680, I would say, is like the par of where we'd like to be, but we can go as low as
Yeah.
620. Like 620 is really going to be like the lowest bar. But it's still a conversation we can have. It's just going to change the parameters of the loan. Leverage is going to be like cut quite a bit. It's going to be a little bit higher. But if they have a ton of experience, like in like 40 deals in the last few years, like, we'll probably take a look at that a little bit differently than somebody who's only done a few deals and like has a 620. It's everything's so case by case. But that's why we want you guys to reach out to us, right? And bring us the scenarios so that we can, at least look at them and guide you and explain a little bit about some of the subtle nuances with how we price and tier out borrowers.
Yeah. Well, there's always mitigating factors to credit score and everything else, right?
Sure.
So as long as you have that conversation, you can figure it out, right? Okay, cool. That's it for the questions. Mitch, this was awesome, man. Thank you. I appreciate it. I appreciate you guys coming on. I'll get like I said, I'll get the attendee list over to you, and then I have the presentation I can cascade out to people that want it too. But man, thank you for coming on. I greatly appreciate it. We'll be back next week with a couple of new lenders and another great afternoon of presentation. So I appreciate everybody taking the time and jumping on this afternoon. And Mitch, always a pleasure to have you on. And we'll be catching up, I'm sure, over the next couple of days.
Absolutely, Scott. Hey, thank you so much again. I apologize for the trouble in the beginning, but I'm glad we were able to make it work. I appreciate you handling the slide deck for me. I know that's a big job. So it's you did a great job. I appreciate you following me along. But thank you guys to everyone who was here too, and thank you for the questions. I look forward to being in touch with all of you, and enjoy the rest of your nights. All right, guys?
Thanks, everybody. Have a good evening. Take care.
Thank you.
See y'all later. Bye-bye.